Let's go back to the year 2010. Do you remember how everyone was googling ESG investing because they wanted to make responsible investing decisions? Oh, you don't? Well, it might be because no one cared about ESG investing back then, unless you were one of those few that were ahead of time. In fact, no one really cared about ESG investing before 2018, but now it has seen a huge expansion around the globe. As ESG investing keeps on booming, you might start to wonder, is it really a way to obtain higher returns on your investments, or is it just another trend that will soon be forgotten? Perhaps you even sacrifice your future earnings with ESG investing. What even is ESG investing? ESG comes from the words environmental, social, and governance. There are many reasons why people want to start ESG investing, but the top 3 reasons are: investors want to increase their return on investments, investors make their investment decisions based on their morals and values, investors want to use their wealth to make the world a better place by investing in companies that are considered responsible. I personally have never really been interested in ESG investing because I have always thought about it as a marketing plan. These days, you just can't find a company that doesn't claim to be responsible. Pretty much every company has a responsibility page on their website, and because of this, I have thought that if every company claims to be responsible, why would it benefit to invest in companies based on their responsibility? And because of this, I recently wrote my bachelor's thesis about how ESG investing affects companies' idiosyncratic and systematic risk, and today I am going to share all of that information with you. First, we have to take a quick trip to the year 1952 and meet with a guy called Harry Markowitz. Wait, why isn't this machine starting? There we go. You might have heard of Markowitz if you are into finance stuff, because he is the man behind the modern portfolio theory. I have talked about him before, so let's just quickly remind ourselves what the portfolio theory means. Don't put all your eggs into one basket, because you can lower the total risk of your investments without sacrificing the expected returns by investing in multiple different investments that don't correlate at all or correlate very little with each other. Let me show you a very oversimplified example to get the point across. If you invest $1,000 in one company and it goes bankrupt, you have lost all your money. If you invest $1,000 in 2 companies that have a positive correlation, it means that when one goes up in price, the other one also goes up in price and vice versa. So if there is a crisis and company A crashes, company B is also going down in value. If you invest $1,000 in 2 companies that have no correlation at all, it doesn't matter what happens to one company. If company A goes bankrupt, company B continues as nothing has happened. Because of this, you should diversify your portfolio with assets that don't correlate much with each other. Okay, so now that we have learned the modern portfolio theory, which in my opinion shouldn't be called modern anymore since it has been 70 years, but anyways, it's time to move on to the year 1964. That is when Nobel winner William F. Sharpe introduced the capital asset pricing model. I won't bore you with too many details again, but the reason we want to know about this before diving into ESG investing is that Sharpe says that when investing, you should focus on 2 different risks: the systematic risk and the idiosyncratic risk. The systematic risk means the risk of the entire market, whereas idiosyncratic risk means the risk of one specific company. According to finance theory, if you are diversifying your portfolio, meaning that you are following the portfolio theory and investing in different assets that don't correlate much with each other, you can get rid of idiosyncratic risk, but there is no way to completely get rid of the systematic risk. Because of this, the capital asset pricing model provides a way to calculate a company's systematic risk. You might have heard about companies having a beta. Well, that beta is the systematic risk. It can be calculated in many different ways, but that is a topic for some other video. Let's now go back to the future and start to talk about ESG investing. Let's first take a look at what studies have found about how ESG factors affect companies' idiosyncratic risk. There is some correlation between lower idiosyncratic risk and ESG factors, meaning that companies that have higher ESG ratings have a lower idiosyncratic risk. This is mainly because of a better risk management and something called the moral capital. To get high ESG ratings, the company has to be able to manage long-term risks related to the environment, social responsibility, and governance. Because this is one of the criteria to even get a high ESG rating, we can deduce that the companies with high ESG ratings must have better risk management than those with low ESG ratings. In 2010, Deepwater Horizon drilling rig exploded and led to one of the worst environmental disasters in the world. The explosion resulted in the sinking of the Deepwater Horizon and the deaths of 11 workers and 17 people injured. over 4 million barrels of oil leaked into the ocean. Because of this, the company that was drilling there, BP, lost over 50% of its market value in 2010, and they couldn't pay any dividends to the owners either. BP also had to pay billions in compensation. Overall, the costs for the company were around $41 billion, not to mention how much it affected the future earnings of the company too. Overall, the costs for the company were around $41 billion, not to mention how much it affected the future earnings of the company too, because of their bad reputation. This example shows greatly what we mean by moral capital. Since ESG companies are supposed to be responsible for the environment, social and governance, accidents like these shouldn't occur to high ESG rating companies. Moral capital is kinda like insurance that prevents negative situations like this from happening, which makes the company more valuable. There is also a correlation between lower systematic risk and high ESG ratings. For example, one study found out that companies with high ESG ratings have lower betas, and since beta measures systematic risk, this means that companies with high ESG ratings have lower systematic risk. Another study mentions that the ESG ratings and systematic risk have a relationship that looks something like this. And this is what shows that it doesn't really help that every company has a website saying that they are responsible. You need to actually do something responsible to get some benefits from it. First, being responsible affects companies negatively because they have to spend their resources to show everyone that hey, we are a responsible company. But after a certain point, it starts to pay back and the company starts to earn some benefits that compensate for the earlier negative effects. Okay, so now that we know that ESG ratings can lower the risk of your investments, let's answer the question: should you start ESG investing? The answer is simple. Maybe.
Yo, what? I spent 7 minutes watching you talk about some ancient stuff, and now you say maybe.
There is no simple way to answer this question, because some studies say that yes, absolutely you should, and the others say that no, you absolutely should not. So, because of this, let me list you a couple of reasons why you should start ESG investing and why you should not start ESG investing. So, why should you start ESG investing? Studies have shown that high ESG rating companies can have lower systematic and idiosyncratic risk. This can mean that the companies will continue to perform well for multiple years to come, and they can handle crises like COVID-19 better than some other companies. Who doesn't like profits with low risks? The main reason why you probably should start ESG investing is your morals and personal beliefs. If you want to make the world a better place by putting your wealth into responsible companies and don't really care that much whether or not you might make only a 6% return on your investments instead of the average 8%, then ESG investing is definitely made for you. Some studies even argue that you might earn better profits with ESG investing. For example, S&P Global Market Intelligence shows that all of these ESG funds outperformed the S&P 500 index. However, in my opinion, it's pretty weird to claim that ESG investing would end up with higher returns. Sure, it's possible, but more about that later. Why ESG investing is a scam? Okay, it's not a scam, but why should you not start ESG investing? First of all, the ESG investing funds have higher costs than just dumping your money into S&P 500 index fund. Some ESG funds have pretty low costs, like Vanguard FTSE Social Index Fund has only 0.14%, but most of them have around 1%. As Tariq Fancy, the former Chief Investment Officer for Sustainable Investing at BlackRock said, what you get is an industry that knows if they put ESG or green on something, they can make a lot more money out of it. While there are indeed some great ESG funds and companies available, it really is true that these days everybody is trying to show how responsible they are, but in the end, are they really that responsible? However, the main problem I have with ESG investing is the fact that why would it be better than regular investing? If you are only investing in ESG investments, it means that you can't diversify as much. It means that you are investing in companies that have a higher correlation with each other since they are all trying to be responsible. This means that you are carrying idiosyncratic risk for no reason at all. If you are just a regular investor, you can invest in everything, which means that you can choose to invest in ESG funds if they seem like a great investment, but you can also choose not to invest in them if an oil company looks like a better investment. So I just want you to think about this question. Why would it be better to limit yourself to only these investments instead of being able to invest in all the available investments? Why would ESG investing have lower risks when a regular investor can also invest in those investments and also choose other ones that might have even lower risks. There just isn't really any way that ESG investing can be better than being available to invest in anything you want, other than your morals and values. Overall, I just want to say that I am not saying that you should avoid ESG investing at all costs. It is also one way to make money with investing, and if these things are important to you, go ahead. It's not like you're going to lose all your money, you will never retire, and everything will be terrible. Yeah, it's possible that you won't have as high returns as some other investors could potentially have, but there is still a positive effect ESG investing can have. Just make sure that you invest in companies that actually are responsible, not in companies that just claim to be responsible. You can use different servicer providers to help with finding companies with high ESG ratings, for example MSCI. They also explain clearly how they are rating these companies. I'll leave a link down in the description if you are interested. So, whatever you decide to do, good luck with your investments, hit the like button and subscribe for weekly videos about anything related to money. I'll see you soon. Bye.